Good day, traders. The 4-step method to high performance trading and the free audio program, the 7-step daily routine for high performance traders, are both free downloads to help you develop the skill set, the mindset, the discipline to master the markets. The link is down below in the box, the description box. They're both free downloads. Let's get started. Good day, traders. Stacey Burke from Stacey Burke Trading, and today we're going to be talking about markets that go out of balance. It's one of the best tips or hacks to maybe identify an instrument that is potentially either in a 3-day setup or setting up, or comparing it to other pairs may I help identify cross-rate pairs that may actually be offering a best trade setup on the day. So again, going back to Dalton and the reminder of when a market closes or opens outside of the previous day's range, it is often a sign that new other time frame activity has caused price to seek a higher or lower level. And what that means that when a market goes out of balance is that it has a high probability in terms of greater risk, but also greater opportunity, because once the market either accepts or rejects being out of balance, it can offer a strong directional conviction that can develop if the market opened and auctioned within the range. The open auction outside of range is capable of generating a big day, while the open auction within value rarely generates conviction. So once a market breaks out and goes out of balance, there's a higher probability that it can continue to move strongly in that direction of the breakout, or it may reject that and reverse. But in terms of identifying a best trade setup in the session that we're trading, that may depend on whether you're trading Asia, London, or New York. And then also in terms of identifying again a cross pair, so perhaps a signal day has developed on an instrument, but it doesn't set up properly in the next day, in the next session that you're trading, but against a cross rate that perhaps was a different. So for example, we could have first an out of balance day long on a day one and against the US dollar, and we could compare that to one of its cross rate pairs to see if indeed during the session that we're trading it offers us a best trade setup. Let's take a look at that. So just a reminder, when a market opens outside of the previous day's range, conditions have changed and the market is out of balance. One of two scenarios is possible. The market will continue to drive in the direction of the breakout, or the market will begin to auction back and forth at the new price levels. So as I've talked about, you can go back and test this yourself and just compare the different thesis of in terms of a market. I always compare the 3 US dollar cross, the yen, the Swiss franc, Canadian dollar, to each other in terms of identifying a potential best trade setup on the day out of one of those pairs. So one may have a signal day, it may not have a signal day, it may just be within range, it could be an inside day. We could have all kinds of scenarios. But just coming back and looking at today, we had the Japanese yen closed yesterday outside of Friday's range, so it was out of balance. The Swiss franc, on the other hand, closed inside of its previous day's high and low, and it has done so the last few days, but it was in balance. And we had the Canadian dollar, which had major red news today, CPI, on the schedule, but it also closed out of balance or outside of the previous day's range, meaning it broke out of the high or the low and it closed in breakout. So you'll notice, for example, on Friday, it broke out of the previous day's range, but it ended up closing back inside. Depending on the session that you're trading, this pair, one of these pairs are out of balance, in balance, and two of these pairs are out of balance, meaning that one of these Swiss cross rates with the Canadian dollar or the Canadian Japanese Swiss cross may have offered a best trade setup in the session that you're trading. So for example, me trading the US session, traders in London had an opportunity for a sell high setup at the high of the week, the high of the opening range, for a high of day to low of day opportunity. So when I come to the screen, the only scenario that I may have had was a low hanging fruit in the US session, but we're already down low. We're already down at the previous day's level. And again, one of my triggers is that a daily high or low has been broken already. So when the US session opened, I was already down low at the low of the day, which is where I don't want to sell unless I have an opportunity to sell high for a move down to or through the low of the day. The Canadian dollar offered an opportunity for the short squeeze on day 3. Again, this was a reset on Friday. We had a market that is out of balance, and this is the textbook short squeeze setup. Typically, we'll close outside of the range on a low of the week scenario. So we have the previous week's low. But what's key about this is that during the session on the day itself, they break through the breakout level of the previous Friday's low of day, and they make a higher high on the inside. That's a snowplow. That higher high on the inside is the setup for the dump and pump short squeeze after the news. The New York Open, a smaller time frame, we can zoom in on this, gave traders an opportunity for the reversal trade right at the New York Open. And coming back to explaining a couple things, if we go back to our 15-minute chart on this, we have the closing price. And as I explained to one trader, this higher high snowplow in the middle is the dead giveaway for the short squeeze dump and pump after the news. The news gave us a break in structure on the inside. So we have our downward movement. Then our news candle takes out all the lower level shorts. And that sets up the short squeeze off the low of the week. But what's key is to understand the closing price here. So the close is roughly in the area of 63. Now you'll notice that all the price action that comes down below that level reverses fairly quickly. And what that means is that they're not allowing anybody who's taken this on a longer time frame. So we already have shorts triggered into the market, but there will be other time frame traders that enter in short on the close of this market, or they've taken this trade assuming that the close is out of, that we've got an engulfment, and they're shorting this in London for the move back down through the low of the week. And when we get our New York Open reversal, again, this trader is not allowed to be in the profit. It reverses very fast, and then it targets the money, the high of the current day, and potentially this market may retest the high of Monday, which is the most recent high after day 2 shorts are triggered into the market on Monday on a break of Friday's high. Ultimately, if this market was to reverse, we could be targeting Friday's high. But talking about the market closing outside of the previous day's range. Now, if we look at the CAD Swiss, so we have a market that has traded from the high of the day, the high of the week, and broken down. So again, addressing the opportunities potentially on the cross rates of the pairs, one that closed outside of the range and one that closed inside of the range in the session that I'm trading. So obviously Europe-London traders had an opportunity for a high of day short trade, but traders in the US session now also had an opportunity for the low-hanging fruit trend continuation trade at the New York Open, which gave in the area of close to 50 pips. No heat, no stress, just a trend continuation trade. So by identifying a pair that was out of balance and a pair that stayed in balance, and then whether or not on the day itself we actually had a trade setup that played out. So we have a high of day short trade that breaks down, and now we have the low-hanging fruit trend continuation setup in the US session. Now in the other scenario, we have the Swiss yen, which we had a market that made a peak formation reversal through the low of the day, but still closed out of balance. So again, just by taking a look at these cross pairs, we also had a market that closed out of balance on the Swiss yen. That market gave a reversal trade inside for a parabolic setup in our Europe-London window, a 3-session setup, US session high, Asia low, and then a retest and engulfment for the parabolic trade right into the London Open. So again, coming back to the opportunity in the US session for me, looking at these two pairs, we have a market that just as the window is opening has already taken out the high of the day. Now, eventually at the end of the 3-hour window, this did continue for a low-hanging fruit trade, But comparing the two, the Canadian Swiss still had lots of room targeting the previous low of day. So again, coming back to not chasing the hot chick, this pair still gave a perfect textbook setup and had not yet taken out the low of the day. So high of day, longs are triggered at the high of the day. It's broken down. Our next target is the low of day. And then, of course, we have the two markets that were both closed outside of the range. And that was the Canadian and the Swiss. Sorry, the Canadian and the Japanese yen. Now, what made this pair interesting to potentially follow is, again, the fact that the Canadian dollar had CPI on the schedule. And we had a nice break in structure on CPI and then the pump up and then the New York dump for, again, an easy 50-plus pips from the high of the day. So we've targeted and hit the high of the day. That's a trigger for other time frame traders to enter in the market. We've got our major red news off the table. That's our break in structure. And now we're on the backside of the move. And then we get our pump and our dump into the New York Open. And this is just by looking at our basket of three major U.S. cross pairs. Again, the Canadian dollar. So we had a close outside of the range on Monday, our day one. It's out of balance. Our Swiss franc closed in balance, but gave a high of day, high of week short trade right at our London window. And our Japanese yen, which closed out of balance. So again, coming back to what Dalton says, a market that closes out of balance potentially may stay out of balance and continue to move in the direction of the breakout, or it may reverse and reject that breakout and pull back inside of the previous day's range. Now, one of the other things that you can do is that when you get a market that does break out, for example, we had the euro breakout and close outside of the range, out of balance. And we had the New Zealand dollar close as a first red day at the high of our week. So we have a market that breaks the high of the week on Friday. Monday reverses. So again, first red day. This triggered the high of the week, the high of the day, which is a textbook scenario, breaks down. So breaks up first, triggers breakouts, breaks down inside, pumps up and closes beneath the opening price. So we have our textbook first red day. So we have a market that, if we compare to the Aussie dollar, New Zealand Aussie dollar, similar as we'll talk about the Swiss and the euro in a moment. So we have the Aussie dollar and New Zealand tend to move in some degree in synergy or in very similar price behaviors. They're commodity-driven currencies, but they tend to sort of reflect each other's movement to some degree. Not always, but we don't get a first red day on the Aussie dollar, and we have a market that has pumped up into the close of the session. And again, that market breaks down. We had first red day on New Zealand. Both of these markets closed in balance and inside the previous day's range. But during the Asian session, the New Zealand dollar breaks outside of the previous day's low and goes out of balance. When we come to the U.S. session, we have a low-hanging fruit continuation trade, but we've already broken outside of the previous day's range. We have a broken down market. We have a market that pumps up to our double zeros, struggles a little bit as it breaks down, just takes its time, still gives us the low-hanging fruit continuation, but identifying the difference in a market that had a first red day setup that trended beautifully for most of the day, comparing that to the Aussie dollar had not broken a previous day's low, and it had followed in some similar suit, and we got a much cleaner, faster, explosive blow-off move in our U.S. window for the low-hanging fruit trend continuation. Again, levels, numbers, and timings. We get a nice triple top M structure that blows off vertically through the low of the day to complete its move before pulling back inside of the range and staying in balance. But comparing the two, New Zealand had already blown off on a signal day on first red day, continued to follow its move, and we're on the lower leg as we come into the U.S. session. Aussie, so we use the term don't chase the hot chick. New Zealand's already blown off the map. Aussie's following it without a signal day, lower low, lower high inside for the pump and dump into the close for an easy vertical, roughly 30 pips of blow off with no heat, no stress. And again, following an instrument in the similar sector or similar characteristics, Aussie and New Zealand tend to reflect each other's movement, but the Aussie gave us a much cleaner setup as New Zealand had already moved through the low of the day and fulfilled most of its criteria. But if we take the strongest mover on the day or on our day one, we had a nice beginning of our new week. We have an explosive breakout on the euro that closes outside of the range, out of balance. So again, we had a textbook first red day, peak formation high, peak formation low, close below the open at the high of the week. And that market blew off vertically right off the bat. So first red day on the New Zealand dollar. And we had a market that closed out of balance and you'll notice, comparing this to the Swiss franc, exactly at the London Open, this market gave a beautiful long entry to continue the trend trade on day two for a nice parabolic move. This is an hourly chart on day two. Exact same time as the engulfment reversal off the high of the day for the move back down to the low of the day on the Swiss franc. So we had one market out of balance, the other one rejected strongly. So if we looked at the two cross rates of the Euro Swiss, I wouldn't typically expect to see a whole lot of huge movement as they are both moving strongly, which means they will be similar correlation in terms of the movement during the day. So no high-low move type of movement. We have a market that's basically traded sideways almost in a 25 pip box for the majority of the session. If we look at the pound and compare this movement, we have a market that also broke out on day one, and that closed well outside of the range, but that was also a move that has now gone day one, day two breakouts, except that this market broke down on the inside and began to go back down during the day, as opposed to the euro, which continued to move up strongly and stay up high for the majority of the day. Looking at our 5-minute chart on the euro pound, identifying one pair that has gone out of balance and continued to move strongly where the other pair closed out of balance but rejected right away, we have an opportunity now for a day that could potentially trend for the entire day itself, euro pound. Which brings us to our pound yen and our euro yen. We have two instruments that have closed outside of balance, the yen and the pound, the yen and the euro. And now we have markets that have broken the daily highs when I come from my US session. So looking at the pound yen, we have a pound closed outside of the range, the yen closed outside of the range. Both markets came back inside of the range, but over the course of the day, the pound weakened inside. And when we come to our US session, we have a low-hanging fruit setup on the British pound, and the pound yen gives us a sell high setup. We have our break in structure in the first hour. Second hour pumps back up into the high before breaking down on the New York Open into the previous high of day breakout. And then the pump up into that breakdown as the third hour opens for the vertical capitulation back into traders that were long at the beginning of the Europe-London window. So we have our death line, our neckline, that's our Batman formation, the breakdown 1 hours, 2 hours, third hour capitulation straight back to the low of the day. Our euro yen, very strong euro breaking out, and the yen pulled back inside of the range, but the euro continued to trend strongly throughout the day. We go outside of the previous day's range. Now, just coming back and comparing these two. The euro has broken outside of the most recent peak formation high of the week. The pound yen has traded up to the peak formation high of the week, broken outside of the previous day's high, and then we've found a potential area for major resistance, major selling, which indeed it did reverse from. So again, comparing the two, the euro is already outside of that range, which again comes back to maybe the pound, and the pound being weaker inside on the day, was the better selection of the two to target a bigger range and a better trade setup. So again, the euro yen, same timing, same trade, broke through the breakout high of the previous peak formation before reversing and coming back up in a strong trend. the pound yen traded up to it before breaking down and capitulating back into traders that were long. So again, targeting best trade setups, but both the pound and the yen closed outside of the range on Monday's closing price of the day, New York closing time. So again, when markets close outside of the range on the 6 major pairs, number one, do any of the pairs have a signal day? First red day, inside day, first green day, any of those types of setups, because then we can sometimes correlate one of the other pairs that have closed outside of the range out of balance. When in the session that we're trading, we may miss some big moves in other sessions or setups in other sessions, but we can still narrow it down to maybe one or two different ones if the major pair has already moved because it's the hot chick, it's already run away, but we have pairs that potentially may be following it in similar movements that may offer us a better trade setup and a cleaner trade setup for easy money. So study markets when they close outside of the range, major pairs, and then understand how that can correlate to pairs that may have a signal day, a weaker pair, or a pair that potentially now is going to break down, or a pair that's going to potentially be really strong. Comparing that to pairs that also have broken out that may not follow through the next day. So now we have disparity in terms of how they will trade in the next day and potentially in the session that you're trading. So study the closing price. Is it in range? Is it out of range? Did it trigger any breakouts during the day? We can have day one breakouts triggered. They pull it back, close inside on one pair, and it continues to trend on day two. And we can have a pair that's closes out of balance and out of range, and the following day breaks down inside, and we can develop a thesis potentially on one of the cross rates for a best trade setup that we may not get on the major pair. So hopefully that helps traders. Excellent question. Again, we'll go back, we'll review this further, but go and identify pairs that you can potentially see closing outside of the range and how that may serve us heading into our next day in the session that we're trading. 1% better every single day. Again, thank you for the questions and feedback. Have a great day, traders, and may the markets go with you.